This is the $64 trillion question. Will stocks crash if the Fed doesn't print money and keep interest rates low? How can this be possible though? They only have $4 trillion on their balance sheet, and comparing that to the size of the entire stock market, it's not that significant. So why does the media really focus on it? Why did the market wet its underpants in December when Powell suggested conditions could still get tighter? Something to think about. You came here for the truth, so let me unveil that for you. Today we are going to look at the central bank balance sheets. I think this is of utmost importance to see this data on a daily basis if possible. It is so important that I believe it is the most important factor you can see. When you look at the central banks, you need to focus on two major things, and that is their balance sheets as well as their interest rates. They determine the liquidity in the system. So we'll go through this today, and I'm going to break it down why I believe it is so important and how you can look into it for yourself. So let's begin with this. So here we are, the S&P 500 is the red line and the blue line is the Federal Reserve balance sheet. And I think it's important to look over these before we move on to the other central banks. Now, you can see what has happened here, that quantitative easing, number one, injected more money in an instant than was ever created in all history before it. That's the level of injection that they created in order to stimulate these markets. Of course, we know the reason why they did this, but that's a topic for a different day. So of course, then we had quantitative easing 2, and we can see how the markets pushed that up. However, once quantitative easing 2 finished, before QE3 began, we had this stagnation almost, where the S&P 500 was up and down. And during this period of time, there was some questions about the future of the markets. Will they be able to withstand everything that's happening in Europe with the Euro sovereign debt crisis? But as soon as QE3 hit the markets, you can see while their assets expanded, so did the S&P 500. And then we had this period of time where QE3 ended, and so did the markets. They went sideways for a period of time. Then again, the markets started to feel the fear, but something changed. And you can see that the Federal Reserve didn't end up printing any more money from that point on. After QE3 finished officially on their balance sheets, it never went any further. So what happened here? Well, we'll get to that more in just a moment, so hang on to that thought. But I wanted to bring you forward into 2018 and after that. So what we're looking at here is a big change. The Federal Reserve started to wean off its balance sheet here, and as a result, we saw the markets falling. But just look at it. You can see how directly correlated these are. Over time, it seems as though these become directly connected, not on a daily basis. Sometimes it takes a long time for it to catch up, but eventually it looks like they move in lockstep. And you can see that very clear right here. Now I want to point out something that is very different than all of the years prior, and that is in 2018 globally, central banks began their policy of quantitative tightening. This is very, very different from what we saw since the financial crisis. Quantitative tightening is extremely important, and it happens to correlate with the downswing that is very apparent in just about every market throughout 2018. Now, if you see it from the end of December 2018 up until present, early February 2019, things have really changed. Almost all assets have risen ever since. Quite a difference, quite a change. So this brings me to the next chart that I wanted to show you. Let's take a look at it. So once again, the red line is the S&P 500. The blue line is the Federal Reserve balance sheet. And then we also add in the Euro area central bank assets as well as the Bank of Japan. And then we get to know a little bit more of the story. So this right here shows us the pink line being the Bank of Japan and the green being the Euro area. Just look at this. You can see the expansion of fiat money during this period of time. time. You can track and trace it, but I want to focus particularly on this moment where the Federal Reserve stopped printing money right here after QE3 ended, and the market started to go sideways. You can see this right here. However, the BOJ and the ECB and the PBOC and others continued to print money, and that pushed up the markets. You don't need to have the Federal Reserve doing it all. That is a matter of fact, and it was proved in this period of time. The money sloshes around in the financial system and will finally make its way around. Many central banks, institutional investors, hedge funds, and everything all the way down to the retail investor began putting their money primarily into US tech stocks. That's where most of the money found its way into until we got to October 2018, and everything changed at that moment. It was such a wild difference. Well, you saw a stock like Facebook, which had scandal after scandal after scandal, but that's a different issue. We had a serious change in people's portfolios from October through December. They started to get rid of all of those growth stocks that had made them a lot of profit throughout that period of time. They took some of that profit and they decided to buy into other stocks that would be considered to be more safe. In doing so, this really rattled the markets big time. There was no diversification whatsoever, even within paper itself. This started to put a huge downward force onto stocks like the FANG stocks in particular. So that is very important to be seeing what has happened in the past to understand what is coming. Now, the central banks themselves have been printing money at a rapid clip. We know that. We can see it here on this chart. I've shown you many others in the past, but it's important to see on a daily basis what exactly they are doing. Just to give you an update, as you might be able to see here, the ECB said that they would stop printing money at the end of 2018. However, they continue to expand their balance sheet. The BOJ, although they haven't necessarily said they're going to stop printing money, for a period of time it looked like they were. However, that has changed and now they're back into it. So between the two of them, it is very clear to me what they are trying to do. They're making up for the fact that the Federal Reserve began their quantitative tightening policy. What is very apparent to me is that the central banks need to print money in order to keep the stock market going. If not, why wouldn't you just retreat all of your assets over a period of time, let's say over the next year, maybe 2-year time frame, and you be able to basically wean off of all of that, remove the crutch, and allow the system to be restored on a natural level, because I've heard the economy is doing well, the markets are doing well, so it doesn't require that stimulation. But of course, that's false. It doesn't work like that, and we make it very, very apparent right here by looking at this chart. Now, something I mentioned in the introduction is the fact that you have these central banks, for example, the Federal Reserve, which currently holds approximately $4 trillion on their balance sheet that they're willing to admit, but you compare that to the stocks traded, total value, current US dollars, and you can see, depending on the year we're looking at, for example, 2017's numbers shows that we are over $77 trillion worth. So if you say to me, well, $4 trillion compared to that 77 trillion, it's not significant at all. And I understand what you mean. If you compare the two numbers, sure, it isn't significant. However, I think it is important to see the effects that took place in 2018. They started to wean off, and a small amount at that, and still the market couldn't handle it. And why is that the case? Why couldn't they actually be able to withstand just a few $100 billion over the course of an entire year? It's because the markets are relying on the liquidity given by central banks, not just the Fed, but all of them. It is very, very important that they fill in the gaps. If you do not present the markets with liquidity, they will collapse. It's not a dream we're living in. You have to get back down to reality and understand what's happening. Case in point, take Powell at the December meeting of the Fed, where he started to say that, look, we're just going to leave our automated roll-off of the Fed balance sheet going. It's going to run in the background. Nothing to worry about, everybody. It's totally automated. We're just going to let it happen. If conditions change, then we are going to change that. If conditions change, we may decide not to hike rates, but you know what? We're probably going to do it 2 times next year instead of 3. Hopefully you like that. And the market wet itself, okay? It wet its underpants and it needed a change. Well, of course, we saw what happened after Christmas. The market started going up further and further and further, and it has been one of the longest stretches we've ever seen of so much positivity, even though it has all been riding exclusively on the fact that the Federal Reserve is quote-unquote dovish. Well, that really shows us the fact that this is all riding on central banks and their liquidity. I talked about this back in 2017. I said that they're planning on QT throughout 2018. If they do this, stocks are going to come down. And we saw 93% of assets in 2018 in negative territory. That was very clear. If they decide to print more money, guess what? Stocks, they can rise again. That's what I am saying. So we'll see what happens. It doesn't have to be just the Fed. It doesn't have to be just the ECB. All central banks together collectively need to be printing money to support the rest of these markets, or else they are going to collapse. One last thing before I end the video here, just wanted to show you this. When you want to know what the central banks are up to, this is one resource you can check out. I showed you the Fred website where you can see those. So basically you just go to a search engine, you type in Fred, and then maybe you could type in the word St. Louis, which is the St. Louis Fed website, but they call it Fred. And so you can check that out there, where you can find a few of the central banks. If you want to know in a list format like this, you can go to tradingeconomics.com. Amazing website, so many different indicators on here, but this is where you'll see that. Of course, not all of them are the most up to date, but it's good to see anyway. You can get a good idea of where they're at for each country to give you an idea of that. So check it out, tradingeconomics.com. I'm going to end the video there. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel. That's all you gotta do, is just hit the one button, hit the like button, and you're supporting me. I do appreciate that. Thank you. And last but not least, if you want the financial education you were not taught in school, these 2 books have everything that you could possibly need, all the way from the foundation, the history of the asset classes, making money, self-sufficiency, everything you need to know. Check them out at the link in the description. If you want the audiobook version, you can get that at themoneygps.com.